Hey everyone, and thanks for jumping back into the cryptoverse. Today, we're going to do a collaboration with Will Clemente. He is a popular on-chain analyst. His Twitter is already blowing up because of all the great analysis he puts out. I will say before we get started, please go follow Will on Twitter. You will not regret it. He does a ton of great work on there, and I have nothing but good things to say about him. Will, it's a pleasure to have you on the channel.
Hey Ben, thanks for having me on, man. I've been pumped all morning to hop on here and shoot the breeze with you.
Yeah, here we go. So, on chain is something we sometimes talk about on the channel, but it's nice to actually get the opinion of someone who studies this stuff day in and day out. So, just sort of like to open everything up, could you walk us through, where you see the market right now, specifically for Bitcoin? Maybe describe like the current market conditions based on what you're seeing on chain. Are you bullish? Are you bearish? Why do you think that? And I'll just give you the floor for a little bit, and then we'll talk about some more specific questions after that.
Sure. Do you mind just enabling the share screen and I could pull up some charts?
Sure.
Thanks.
Okay.
All right, cool. Can you see?
Yeah, we can see.
All right, cool. So I think like there's two main bull and bear cases in on-chain. First of all, we have the bullish case, which is predominantly just the accumulation that we've been following, and we'll get into the different ways that we're looking at this. And then the bearish case is more so in the transactional activity. And so we'll start with these accumulation trends. So first, you're seeing, and I guess where we can start is over time you see that this behavior between long-term and short-term holders. You see this divergence between the two, where when you're going into strength, you see the long-term holders begin to sell their bags, and the short-term guys, so the speculators, come in the market and basically buy their bags the whole way up. You head into weakness, the long-term holders then reaccumulate those coins, the short-term guys move out of the market, and then once a certain amount of supply is locked up by these long-term holders amidst the bear market, you get some sort of supply shock or supply squeeze effect, and you move up. And so you can look at this two different ways. So first of all, we can look at what I have on the screen here, and this is using Glassnode's entities data, and specifically their liquidity. So this is looking at the spending behaviors of all the different entities on chain. So an entity is defined as it's just a forensically clustered address that's saying, okay, it's one person, it's one corporate balance sheet, it's one fund, it's one custody solution. And so you're looking at the spending behavior of those entities. So there's highly liquid, liquid, and illiquid. The highly liquid guys, they sell over 75% of the coins they take in, or they only hold on to 25% of the coins they take in. The liquid guys, they take in about half, move out about half. And then the illiquid guys, they hold on to at least 75% of the coins that they take in. So AKA, they only sell 25% of the coins they take in. So this ratio I have up on the screen in this blue line, this is a ratio I created with Willy Woo maybe 2 months back. And it's a very simple comparison of you're just measuring the strong hands, so the illiquid guys, divided by the highly liquid and liquid guys. And so what you get is essentially the movement of coins from strong to weak hands, or from weak to strong hands. And so when you look at this in kind of a broader sense, what you'll see is that when we head into these major bull rallies, you start to see coins get locked up by these long-term investors. So you see here, we had a down draw here, boom. And then when we head into the bear market, you see a lot of coins move from these long-term investors and start to become liquid again as we're moving down. And then you get into the bottom of the bear and you start to see a bottom carve out in that. And then we move into the next bull phase and you start to see those coins get locked up again. And then heading right before, into this little mini summer bear market, whatever you want to call it, you started to see a lot of coins become liquid, along with this another thing we can talk about, but the exchange balances, right? Everyone I think is aware of the exchange flows at this point. You started to see a lot of coins move on to exchanges. You had about 145,000 coins that moved on to exchanges in about a 3-week period in early May, along with these coins becoming liquid. So this at this time, would have turned bearish. Didn't have this metric at the time though, just for the record. But here, what you see is that, let me see if I can get a more zoomed in version. Here you go. So keep an eye on the blue line. You'll see we had this bullish divergence where coins were starting to get locked up by these long-term investors with little spending history, while at the same time we had price kind of grinding sideways bearish. And then we got some, I guess you could call this I like to call it an impulse, right, upwards. And then recently you've started to see a second move up. Let me pull up the most recent newsletter. Here, I've just drawn it out a bit better. You'll see here the purple line is the exchange supply shock ratio. That's comparing the amount of coins available to be bought on exchanges to the amount that aren't. But you see this divergence between the two in summer, and then we've just got this recent one over the last, call it, month or so. And so that's one of the main trends that I'm following. You can also look at so this is more so looking at like the qualitative view of the investors that are buying coins. You can also look at it in a more so this is using the liquid data. The other way to look at it would be based off of the amount of time that the coins are being held. So you're differentiating in two ways, because you're defining these strong hands by either their spending behavior or just the amount of time that they're held. So like Glassnode's run some statistical studies, and they find that once coins are held by entities for a certain amount of time, the likelihood of those coins being spent drops off. And so hence we have something called long-term holder supply, and that's Glassnode's definition. And so what you see is this same dynamic that we talked about earlier into the bull market. The amount of supply held by long-term holders decreases into the bear market. It increases, and then conversely with short-term, you're also seeing a large amount of coins getting locked up by not only the entities with little selling history, but also these long-term guys. So you're starting to see these long-term holders buy discounted BTC, but also these short-term guys aging past that 155-day threshold. And to me, that's pretty interesting, because when you go back 5 months ago, well, where were we 5 months ago? That was May 1st, right before we absolutely dropped off. And so to continue to see the long-term holder supply increase, which is, by the way, at all-time highs, along with illiquid supply being at all-time highs, when you continue to see that increase, to me, that's pretty remarkable, just given the context of where we were 5 months ago. You had these people hold the whole way down and have kind of set that floor. And if I can find... Can you see Glassnode? I just don't know if I move the tab, if you can still see it.
Yeah, I can see your screen.
Okay, cool.
It's interesting because it really does show, I guess, I mean, it's more or less what we all sort of naturally think anyways, the idea that there's longer term holders, and when the market goes parabolic, they're selling off to the people that are more so just in it for the short, the shorter term time frames, and it's almost like the smart money selling to the dumb money to some degree.
Exactly.
Would be sort of like the most brutal way to put it.
No, exactly. That's what it is. And like here, I couldn't get that chart to pull up, but here's another one. This is whales. So you're looking at all the entities with more than 1,000 BTC. Excuse me. And then you're filtering out all the exchanges. You're filtering out Grayscale. You're filtering out the Purpose ETF, QBTC, like all these known entities that we can identify, right? And so you're just getting what are the unidentified whales in the market. And what you see is, like, when you look at this in a broader context, when you have these large upticks, you have this one that didn't translate to positive price action. Although I would argue that this slope isn't quite as high as this one, and maybe I should have also highlighted these zones here, although we dumped after. But the general point I'm just trying to get across with this chart is that when whales start buying, that's generally at the beginning of when you want to really start buying heavily. Whales really kind of initiate these price rallies because they have the big money in the space, and they also start to sell into strength, just like the long-term holders. So this is basically a chart following the smart money in the market, and we've just started to get an uptick in the whales in terms of their buying. And you can see like they sold the top here, they sold into strength in 2017, they sold the top in 2019, also in 2013. And so this is a pretty telling sign to me. We've had whales buying since I think it's July 27th through July 28th. They bought over $8 billion of BTC. And so that in correlation with some of those other accumulation metrics we touched on. Also, you can look at like the HODL waves, right? This is showing like the last time supply was moved in each denominated cohort. You have an all-time high in supply that hasn't moved in at least a month. So over 93% of supply hasn't moved in at least a month. And so that's really the bullish case for me. But when we talk about what's the potential bear case, that really lies for me in a lot of the transactional activity. So we're looking at transaction count. What's the mempool look like? We can look at fees as kind of a proxy for demand of the network. You can also look at active addresses, active entities, which is using Glassnode's clustering data, and then also entities net growth is another chart that I like to look at. So I can pull that one up. And this is looking at, so we look at all the entities on a given day. You look at the new ones coming on the network and the ones that are perceived as dormant. So they hold no coins and they aren't active at all. You subtract them and you get this net entities growth chart. And what you see, let me throw a moving average on here. Here. So go ahead. Sorry.
Oh no, I mean, I'll let you finish with this train of thought. I was going to go back to one of the other charts, but yeah, go ahead and show the transaction stuff you were talking about.
So you'll just see like this has dropped off a cliff, and we're still kind of hanging down here in like no man's land.
Yeah.
I think you could make an argument, like a counter argument to this though, and say, maybe just the speculators are gone. And when you look at like what size transactions have dominated volume, it's been really large transactions. Like over the last week, over the last month, we've seen a spike over the last week, but it's really been over the last month. You've seen these large, $10 million plus transactions dominating all the volume on each given day. So I think you could build a case. Also, you talk about, batching exchanges are now using batching for their transactions. Also the Lightning Network, although I think that has a smaller effect than the other two things, although that's probably the popular narrative with Bitcoiners. But the Lightning Network is still very small, so I don't think it could suck that much of the transactional activity off of the base layer. But to me, I think you could make a case both ways and say, there's no demand to use the network, but then you could also say, these are larger entities that are dominating right now, aka probably institutional sized capital.
Right. Yeah, I mean, it's interesting because I was looking at that a couple weeks ago. Like the transactional, it's not super high right now compared to what we may expect. But the fact that that large transactions are sort of dominating, it sort of begs the question: who is that, right? Like, who are those people that are accumulating? And a lot of these guys, these big players, they're not really so much interested in these short-term moves, right? So, like for instance, when you were showing one of the other charts, you showed that there was sort of like a fake out in March of 2020, I think, where it sort of seemed like, hey, like we're heading up, but then there was there was that pandemic drop, right? Which took all markets by storm there. But those are the sort of things, I guess, where on-chain is not really meant to predict what's going to happen tomorrow, right? It's not trying to say like, hey, this is going to happen tomorrow, because again, it's all on-chain. We don't see everything that's on exchanges and whatnot, and I'm sure it doesn't account for cascading liquidity events and that type of stuff. But would you agree that on-chain is more so used, say, like for macro shifts in the market, like like gearing up for another bull phase, even if it means like it might not happen next month or 2 months from now. Because I mean, we can see that the transactional count isn't that high. We also know historically a lot of times speculators will come in once it's already going parabolic, right? So like if you go back and look at this chart, in 2020 the price of Bitcoin was doing relatively well. I mean, we went from 3,800 in March to well over 20K by the end of the year, but it's not like the transaction stuff didn't really go up until the very end, and then it really spiked going into 2021.
Right.
So
You say that also with the long-term and short-term holder dynamics too. What I was
right,
saying,
yeah,
like,
exactly. So it's almost like it would make more sense to be buy or it almost like once you get to that mania phase where the transactional count is going through the roof, it's like, well, you kind of wish you had your position before you got to that phase, right?
yeah, totally. So I think you framed it well. Some people say that they use on-chain on shorter term time frames. I think you can. There's some tools, on-chain tools that you can, but for me personally, I think the sweet spot. Maybe it's just the way that I interpret things, but I think the sweet spot is like 1 to 3 months out. I mean, I know some people that look at like intraday exchange flows. I mean, I don't look at any of that, and like I'm do like on chain for a living, right? Like,
Right.
the thing is, if I was a whale and I was gonna, if I could just send some large amount of Bitcoin to an exchange and dump the price, right? Everyone like freaks out, say, "Oh my gosh, this guy's selling." I'm gonna do that, right? It costs $10 in transaction fees to just send the BTC to exchanges, and then you can go short, and then the market dumps because they freak out because everybody thinks that someone just moved a bunch of coins on to sell. And then also like the heuristics, just like it's like fine wine, right? I don't drink wine, but over time, the algorithms and like the clustering heuristics that these data scientists are using at Glassnode, it gets better over time. Whereas like the exchange balance data, a month ago is not going to change much, but over the last day or two, well, when you look back at it, maybe in a week, it might look a little different. So, when you're talking about stuff on like inter day basis, you can get caught up in a lot of noise there. So I don't pay too much attention to that. I think when you're looking at the shorter term time frames, you can look at order books, and we can get into this too, like these massive bids on Bitfinex and perhaps like a nuanced view of that I have. But I look at order books, and then also the derivatives data. I think the derivatives data, in particular the futures data, is probably the most important information for these. What's going to happen over the next couple of days, what's going to happen even over the next couple of hours, right? When we're looking at things like the futures basis or funding rates, or you can look at just open interest. These derivatives metrics are much more important on those shorter term time frames. And then also you have price structure, right? You're talking about just moving averages, in the sense of mean reversion, and then also price structure. I think those things hold a lot of weight in the short to intermediate term. But when I'm looking at what's the macro of Bitcoin, right? I kind of think of myself as an economist of Bitcoin. It just economists don't have a fully open, transparent ledger that they're able to pull their statistics from, but I think we can build a case for what's going to happen in the broader sense. And then when you're talking about these more shorter term price fluctuations, you can use some of the tools that I mentioned.
Yeah, I mean, one of the things that I've often, and I think I'm not the only one, but I'm sort of coming around to it, and I'm appreciating on-chain data more and more as I explore it myself. One of the things I'm interested, and I think a lot of people are interested in, is anyone who's been following on-chain data for the last 2 years or so is fully aware that most on-chain data is very bullish, right? And I mean, again, why shouldn't it be? I mean, the price of Bitcoin has gone up from $3,100 in 2018, and now it's trading, at just shy of 50K. There's obviously been a lot of, I mean, if you had to be either a bull or a bear, you would have been much more better off being a bull during that time frame. But like in the future, what are some indicators? And I know you already touched on one of them, so maybe we could revisit that as well. But what are some indications that we are getting overheated from an on-chain perspective? And like, could we look back specifically at that phase of 58 to 64K and say, hey, like in hindsight, this is what was happening. Even if so in the future, when we see this same type of stuff happen again, it could be an indication that that we are in fact getting, maybe not to like a market cycle top. I mean, even a market cycle is somewhat ambiguous anyways, but we're getting overheated in the short term, and maybe we need to pull back for a little bit. So could you like walk us through what you're going to be looking for to try to identify that?
Yeah, totally. I think it's a really valid question. I think first of all, on-chain really has gotten the spotlight over, call it, the last year or so, and at the same time, we've been in this raging bull market. So I think there's a bit of correlation there, and then having some of the bigger names bullish in that 50-60 range definitely wasn't a great look for the space. But we live and learn. We have new metrics now, like the remember the blue line we were looking at earlier, the liquid supply shock ratio. That's one of the metrics where, if I had used it back then, and maybe I'm just coping, but if we had that back then, I would like to think, once you started to see a really strong move down in that before price moved down, that I would see that as a leading indicator,
Right.
similar to how we used it to call the reversal at 30, 35K. Another thing is we talk about the behavior of these long-term guys and the whales. So as a general premise, like these entities don't perfectly sell the top, right? They don't like a top tick every market cycle. They accumulated the whole bear market, or in this case, a lot of these guys bought 30, 35K. They're slowly selling into strength into the main part of the bull run. They're not worried about perfectly timing these tops. So when you start to see long-term holders and whales start to sell, that's an indication of, okay, maybe we're in like the fifth, sixth inning, right? And then you have this crazy euphoric, speculative bid that drives the price up into these kind of blow off tops that we've seen traditionally. This is one of the metrics that I've been looking at lately to kind of identify, are we having some kind of dead cat bounce, right? People are talking about, is this just another complacency shoulder like we have here? From an on-chain perspective, this is one of my favorite metrics to try to build a case for or against that. This is our spent output age bands. So we're looking at all the spent outputs on a given day, and similar to the HODL waves, we're separating all these different entities into. Well, we're separating all the outputs, not entities, based off of these different denominated time cohorts, and so we're looking at every day how much of what percentage of all the outputs are coming from these different these different specific cohorts. And when you had this dead cat bounce in 2017, you see this crazy spike. We had outputs over 6 months, because I've deselected up here. You can see I deselected all the ones under 6 months. So we're looking at the closest thing you can get to that long-term holder threshold, because remember that's 5 months. So here we're looking at 6 months.
Right.
It was 45% of all the outputs when we had this dead cat bounce were those long-term investors. And so this would have been a huge red flag that you're seeing all these long-term guys use this move here to just jump ship and take exit liquidity. Whereas here we had this one-off spike in August, but generally we've actually seen the average age of all spent outputs in decline. And we can see this in another chart. This is the ASOL. So this is average spent output lifespan, very similar, seeing a decline there. And then also this is coin days destroyed. So the way you think of this, let me zoom out. The way you think of this is like, if a coin is in a wallet for 1 day, it's accumulated 1 coin day. If it then moves out of that wallet, then it's destroyed 1 coin day. And so, when you have high destruction, that means that old coins are selling. And so you can see we've been in this like perpetual decline since like November of last year. And more specifically, zooming in here, I mean, you can see we had this spike on this rally, but generally, we continue to decline in terms of the amount of coin days that are being destroyed. So you're seeing strong hodling behavior. We talk about accumulation from these long-term guys. You're also seeing low spending in them. It's just another way of kind of looking at the same thing. And so to me, like, to answer your question, I know I went off on like a whole tangent there, but what I would be looking for is, are these long-term guys starting to jump ship? Are we starting to see whales selling? That can kind of give us an indication of, oh, we're getting towards the latter half of the bull cycle. And then also we can look at some of these more the oscillator kind of metrics in terms of on-chain. So this is one of my favorites. This is the market value to realized value ratio.
Hmm.
So we're looking at the market value, obviously, is just supply of Bitcoin multiplied by the price. And then we have the realized value. So realized cap is the capitalization of Bitcoin based off of when coins were last moved. So for example, like if Roger Ver, let's say, he bought Bitcoin at like $1. Let's say he bought 100,000 coins, right? That's $100,000 that he put into the network. In realized cap terms, now if he hadn't moved those coins at all, there would still only be $100,000 added to realized cap, even though in market cap terms, right? I'm just using a 47K Bitcoin example. That's a $4.7 billion chunk of that market cap. So you're basically getting like an on-chain VWAP, which is just a volume weighted average price, and you're getting the average price based off of where investors kind of bought in or what their cost basis is, and then you run the ratio of the market cap to realized cap. And so when you z-score that, and this is what this metric does, you'll see you get these nice little buy zones down in the bear market, and then also we have these overheated zones above. And so we kind of poked into that, but we didn't really poke above the range like we did in previous cycles. So this is another valuation mile. Based off of this, I would say we're relatively underheated, if you will. Let me pull up another. This is one that I've created myself. I actually created it like 2 days ago. Hold on. I'm going to use the newsletter because it's labeled, so it'll just be easier for people to follow along.
Sure.
So I call it the delta valuation model. And so what delta cap is, and this is using delta cap. It's the difference between the average cap, so the all-time moving average cap of Bitcoin, and the realized cap, which we just talked about what that is. And so delta cap is, it's a very conservative floor, right? Like it's rarely gotten hit, and it usually underestimates. But this is like the absolute on-chain floor. And so when you take a multiple of that, you've also got these nice tops that you can kind of pick off. And I put these little red circles here. And then the blue line is just the mean between the two. And that's just been an interesting level that price has interacted with historically. Like you look at 2019, but you can see we're in this, right in the middle of it. We're not really, if you're along the bottom line, right? Like if you're near a delta cap, you can take statistically more risky buys, right? Because your upside is way more skewed than the potential downside. And then same with the top, like, once we cross above this blue line, it's probably a good time to start de-risking a bit.
So the green line is sort of like if the bears are right and we end up going into like a long bear market, then the green line would probably be sort of like the absolute floor as predicted on chain. Is that right?
Yeah, for sure. And like you can use that in confluence with realized cap. So realized cap, as we mentioned, is basically like the cost basis for all the market participants. And so whenever you start to go below realized cap, by definition, you have capitulation in the market, right? Because you're essentially saying that the market is below what everyone's average cost basis is. So let me just pull this chart up so you can see what I'm talking about. So once you start going below realized cap, that's when you want to start accumulating heavily. Versus, when you get really close to some of the top cap models, it's time to de-risk.
Well, it's also the same time when people don't like to buy as well, right? When everything.
Right. Oh yeah. Like here you'll see like this is when the market in aggregate is underwater. So using this in confluence with the delta cap, if I were to, I don't want to like waste another 10 seconds, but if you added on delta cap here, right?
Right.
Buying between delta cap and realized cap is when you really want to buy heavily.
Yeah, I mean it's sort of like one of those things where yeah, like no one really wants to buy at those levels, and most market participants leave. But that's actually where all the real money is made. That I mean, buying in the bear market is the ideal scenario, I think. So let me ask you a couple more questions here. So I really like what you've done because not only I mean you showed the on-chain data, you've made the bullish case, But you also presented some stuff that said, all right, well, what about the transactional stuff? Like that doesn't look like at the moment it's like incredibly bullish, but we also know that the bullish times come at the phase where you don't really want to be the person buying at that point, anyways. Um, what are you leaning towards? Like, right? Let's say, like, what are you leaning towards right now? Like, oh, if you take everything under the sun that you have, do you lean bullish? Do you lean neutral? Or do you lean bearish?
So I definitely lean bullish, especially when we talk about into the latter half of Q4, leading into Q1 of next year, and that's just based off of these supply dynamics. Because I think transactional stuff is definitely important to keep in mind, but I think the supply stuff trumps everything. Where I think of it as, we've basically laid out the gasoline, right? And all you need is one spark. And so once the liquidity that's on exchanges is overcome, once you start to, let's say you have some big announcement and there's a huge amount of demand, well, once that liquidity on the exchanges is maxed out, then you have to source coins from the outside, right? And no one
Right.
wants to sell because we're seeing this large amount of holdings. So the only way for people to buy Bitcoin would be for the price to have to go up. They have to bid the price up.
Mm-hmm.
And so I think we have the fuel laid out, we have the gasoline laid out, but now it's a question of like, do we get that spark? Do you get an announcement? We're talking about these whales, right? We had Saylor announce that he bought whatever 2 weeks ago. I forget how much he bought. I think
Right.
it was a couple hundred million, and it was all in the on-chain data. I made a post and I said, look, we've been tracking whales have bought X amount of BTC. Saylor bought a small chunk of those. Well, who what are the other names that have bought the rest of the coins, right? Like he accounted for like 2 or 3% of all the whale accumulation we've been tracking. And so I think if you start to see some people stick their neck out, you'll start to see some external demand come in. Also, you talk about like the ETF chatter. There's many things, or you talk about maybe Elon reversing his stance on the regulatory. I mean, with the ESG stuff.
Right.
Or we have some favorable regulatory news come out. I
Like
think there's a lot of different.
an ETF
Sure,
movement.
yeah,
Yeah.
yeah. I think like yeah, there's a lot of different catalysts that could set it off. But when you talk about, is it laid out in preparation for some kind of massive rally from a supply standpoint? I think absolutely. But right now we just need the demand to come in. And if you start to see that once again, like once the liquidity is completely saturated on exchanges, no one's, at least now from what we've been watching over the last couple of months, no one wants to sell their BTC. These long-term guys are sitting on their coins. Their holdings are at all-time supply. I mean, at all-time highs. The only way that these people are going to be able to get their hands on BTC if these trends continue is going to be for price to get bid up. So that's kind of my base case. Also, the transactional stuff sometimes is a lagging indicator because, as we talked about, sometimes that just happens when all the speculators are gone, and we're talking about we've got these the networks dominated by these large transactions as well. And so I definitely lean in the camp of being bullish, but I don't think it's everything is completely rosy from an on-chain standpoint. You want to see that follow through from that transactional stuff once we start to pick up. Like one other thing is you can look at like off-chain stuff to also make an argument against retail being in the market. You look at like Google searches, right? Or you look
Right.
at Coinbase app downloads and all that kind of stuff. That's all way down. I remember Coinbase was like number one on the App Store. Now it's down at like 40th or something.
Yeah, well, I mean, the whole speculator argument, I mean, that's what we need, right? Like the everything's ready. We just need the speculators to speculate and bid the price up. And bidding the price up will get the long term, the longer term investors to move Bitcoin to the exchanges to sell it to them whenever it gets to those prices, I guess. So, there's also been a lot of talk about Bitcoin and market cycles and that sort of stuff. And I'm curious what your thoughts are. You mentioned, things look great right now. And from an on-chain perspective, there's a lot of reasons to be bullish. Do you have, do you have like any ideas or any projections on where you think Bitcoin's headed? Do you think it's going to end this year? Like, is there reason to be super bearish heading into 2022? Or just kind of give me your thoughts right there. Like, do you think we're gonna rally for a bit longer, or what do you think?
Sure. So from like a very macro perspective, I'll show you this chart, and then the other one I don't know where it is, which newsletter I put it in, so I'll just talk it out loud. So this one is looking at that illiquid supply shock ratio and measuring it over time. What you see is that over time, this has been in kind of this perpetual decline until early to mid last year. And this was just saying, in aggregate, supply was becoming more speculative, or moving to more speculative market participants. So we started off in the bottom half of this channel, moved up into the latter half, and then coincidentally, right after COVID of last year, perhaps maybe because people are now viewing Bitcoin as some kind of inflation hedge,
Right.
you've seen us break out of this channel, and now we're kind of free floating in what's uncharted territory. So this, and then you pair it with something called the long-term holder supply shock ratio. We like to make all these fancy names for these things. It's just a ratio of the long-term holders divided by the short-term guys. And so when you plot this out, we've reached this zone of what I consider to be supply shock, right? Like it's, and when you head into the bull market, you see the ratio decline as short-term guys take up larger portion of supply. And then into the bear market, you see the converse effect where the long-term guys soak up supply. We've reaccumulated all the way back into that zone of supply shock faster than we have any other time aside from the mid 2013. Like 2017, it took a while. It took about a year and a half for long-term holders to completely reabsorb those coins. Now it's taken like 5 months. So that's completely different. I personally stand in the camp of we move away from the 4-year cycle, especially because miners are really irrelevant. Like their selling pressure is irrelevant. Plus, a lot of them aren't even selling. Like I work for a Bitcoin mining company, and I could tell you, like, these guys are looking to HODL their BTC for the most part. And then also you see that in the data.
Right.
You've seen generally, you see some selling into strength like in February of this year, but generally, miners are holding their coins more than ever because they have access to the capital markets. And so I just don't think the miner sell pressure is relevant at all. You talk about like when you have an ETF, right? Let's say they have to sell 2% of the supply that they hold, as a fee. Well, that sell pressure is going to be way larger than, especially whenever we get an ETF, you'll probably see a lot of new capital flood in. But, that sell pressure is going to be way larger than anything from miners or also exchanges. Not all exchanges do this, but you also see like Coinbase say they're taking 10% of their revenue and putting it into crypto assets. But most exchanges just take the fee and sell it onto the open market. And, when you look at all these different dynamics, I think the mining, the whole 4-year cycle evolving around miners, I don't think you could really make that argument anymore. I think you could say it's a psychological thing potentially.
Right.
But when you talk about, we have these new market participants in the market and we can see they're here, we know they're here. I think, perhaps you're setting up for a more free floating price structure. Like I'm not saying that I'm not in the camp of this whole super cycle thing.
Mm-hmm.
I just think of Bitcoin as being more free floating, and you plot Bitcoin out on these very pretty logarithmic, these logarithmic cups. I think potentially Bitcoin just becomes more free floating in correlation with macro stuff. Talk about like real rates, and we have these more like dampened volatility moves up and down. But that's just my framework of thinking. We'll see if the 4-year cycle theory holds after this year. But I think some of these like data points analyzing investor activity are pointing to kind of unprecedented waters, if you will.
Yeah, no, I completely agree with you. I think you kind of hit the nail on the head. And I mean, on this channel, you're in good company when talking about no longer being on the 4-year cycle because I've never really believed that as much. But it's interesting that you mentioned the idea of sort of a free floating type thing. The problem I think with market cycles to some degree, and we've talked about this a little bit recently, is how they're somewhat ambiguous, like in defining like what even is a market cycle, like when does it start, when does it stop. Like, I mean, do you define it by a certain drop in the market? Like, does it have to drop 80%? Is that what defines a market cycle? Because if it's only an 80% drop, then you could say that middle of 2013 was a new cycle because we had an 80% drop in the middle of 2013 and then we kept on going. So it is interesting. And I do think that as we continue on, like, well, I agree. I think we're gonna veer away from that 4-year cycle. But I would say, and I imagine you would agree that maybe you would agree. I don't know. The halving, while it might not always catalyze, a 100x move in the market, it probably will be a reason for, some hype to be generated around Bitcoin at the time. Um, we've seen that now 3 times.
Yeah,
Um,
I think about it like if we all have these 4-year cycle models, like if all these institutional guys are looking at the stock to flow model or whatever, we have these like logarithmic models. They're saying, okay, well, this phenomenon happens every 4 years. Why am I going to wait till the months before? I'm just going to front run the thing, right?
right.
If we go into like another
Yeah.
perpetual bear market,
Yeah.
I think like, when everybody is looking for the same thing to happen, then you probably don't get that. And so I think
Right.
that that's probably the case with the whole 4-year cycle.
Yeah, the markets adapt to to what we've seen, and even you mentioned stock to flow. We had we had Plan B on our channel not so long ago, and one of the things that he clarified for everyone is that the stock to flow model does not say that we have to peak in 2021. In fact, his prices are average prices, not peak prices. So in order for us to have average prices of either 100K if it's the stock to flow model or 288K if it's the stock to flow cross asset model, you actually have to we need to spend some time up at those at prices higher than that in order for that to be the average. So considering we're
Totally.
not even above those prices yet, it would also stand to reason that we have a way to go. I think he's also leaning bullish in 2022 with regards to his cross asset model, the one that an average price of 288K, I think.
Yeah,
Um,
I'd like to know what his on-chain floor model is. It seems like
yeah,
it's been doing pretty good so far.
yeah, it's been doing
My,
pretty. Yeah, it has.
yeah, like I think he said 43K for September. We closed right above it. I have a floor model that's at let's see.
Yeah, where's your floor model currently at?
It's right. It's just above 39K. This is it right here. So it's not perfect. Like you'll see, we went below mid
Right,
2017, very briefly in 2018, and then recently. But what it's doing is like it's not like some crazy calculation. It's just the stock to flow model using Glassnode to liquid supply data. So
okay,
like it's basically an attempt to create a valuation of Bitcoin's real time scarcity
right.
because yeah, because you're getting like the active movement of these liquid entities, and that's right around 39K. So we'll see how it holds. I mean, like I said, it's broken before. I still think though it just serves as a good proxy to say like, okay, we're near the floor. It's probably a good time to start averaging some
Yeah, I
buys.
mean that's one of those things where all models are wrong, some are useful, right? Like
Right.
there's not a single model I think that's going to tell exactly what will happen forever. Like, right, there'll always be deviations from it. I look at this chart and I say, what the main takeaway I get from this chart is anytime it's below the line, you would have been doing really well had you just bought Bitcoin and waited.
Yeah. Yeah.
Not to say that all right, yeah, the model's not useful if it's below the line. No, it just when it's below it historically, you're doing quite well. I mean, you see even when it hit in the bull market back in was that like 2017, it still would have been a good time in 2018. And then even before takeoff, when we were at
Yeah. Right here.
10K earlier
Yeah.
earlier in 2020, and then the most recent June and July, or the slump we had going into the late June and July and whatnot is another example. Is there any way to I don't know if you've looked at this. Have you speculated on what this model would be like a month from now, 3 months from now? Is that something you've looked into yet?
Well, no, because like it's hard to predict what the liquid guys are going to do and like predict their movement. Like I guess you could do back tracing and try to come up with some like predictive modeling there, but I think it would just be really difficult to like predict exactly what, we might have some crazy, the Fed comes out, says they're tapering, all of a sudden all these liquid entities start dumping their coins, right? And
Right.
they're gonna, yeah. So I think it's just hard to predict what's going on, with these liquid guys. So you kind of just follow day to day.
Right. Yeah, this floor model seems a bit more conservative than I think the one that Plan B was showing, right?
Yeah.
Yeah. Well, hey, there's nothing wrong with being conservative.
The more models, the better, right? We just
Yeah.
look for confluence, and that's all it is.
Yeah, I think that's a great point. Well, Will, it's been great having you on. I think that on-chain data is certainly something that will want to spend more and more time looking at, especially as it evolves and the main on-chain analysts become more aware of or at least we get more of these indicators out and we kind of see how they behave with time. Because one of the biggest things we don't have is we just don't have a lot of data, right? And the more
Sure.
data, um, the better, right? The more data, the better. But it's been a great time having you here. I would recommend everyone to go check out Will's Twitter. Again, he's actually pretty active on Twitter, and if you like these charts, he posts these charts all the time on Twitter, and I do think he's certainly a good follow. Will, it's been a pleasure having you on, and hopefully we'll have you on again in the future, maybe when the market's a little bit crazier.
Yeah, that'll be fun. Thank you so much, Ben. I really appreciate you having me on, man. And I love the conversation. Maybe I'll get you on my podcast here in a couple months or something.
All right, sounds good. All right, bye.
Bye.